welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think in aggregate, following last week's shock in the AI trade with all of the DeepSeek news, I think one of the themes that's coming out of earnings season so far is that hyperscaler CapEx in the United States is going up. Meta talked about $60 to $65 billion. Microsoft has been talking about $80 billion, and last night, as you mentioned, Google now talking about $75 billion in CapEx. I think consensus estimates were looking for more in the low $60 billion range.
Experience has had a better than expected quarter in many ways. Despite the fact that we had hurricanes, the business was flat in line with the guide, and X that was up about 6% from an operating income basis. So overall, the company's really firing on all cylinders right now, and I think we're fueling it well to continue to see that performance.
It has been a tremendous run over quite a period now. And we're really pleased with the 26% growth we saw in 24. When we guide a bit lower for the coming year, it's really because that we grow on a larger base. We actually see the same continued absolute growth as we look into 2025. We're ramping up capacity significantly.
We've got 1 hour to go until the market close, and we're taking a look at the major averages here that remain mixed. The Nasdaq has not managed to claw its way back from the negative, but the other major averages have. The Dow now higher by about 260 points after sort of zigzagging, playing with some negative territory earlier, has been pretty solidly positive today. The S&P 500 also turned decisively positive around midday, now up about 0.25%, but the Nasdaq still struggling here. Couple of puts and takes, as you like to put it, that are going on today. This morning we got an ISM services report that was a little bit cooler than estimated. So that I guess it's one of those bad news is good news things, right? We've got yields here at 4.42% on the 10-year. If you look at the year thus far, we're pretty much the lowest that we've been in yield. So yields, not a concern. That seems to have helped stocks recover. But in the background, of course, is the story on big tech.
Yeah, big tech. Let's check out some of those names. I'm looking at, some of them were very dramatic today. I'm looking for Google here. There we go, down 8%. Alphabet. What was interesting is the street kind of interpreted this as mixed results. I mean, you saw analysts saying actually solid search in YouTube, but as we talked about, it was cloud softness. I think one thing investors are trying to think through, Julie, is that kind of a yellow flag for Amazon tomorrow in their cloud business? We're going to find out soon enough.
Well, and Amazon shares are down 2.4%. So it does indicate that, you had Microsoft, the cloud business, not necessarily as spectacular. Then you had Alphabet. Is Amazon going to be the third leg of that stool? But elsewhere, we're seeing some recovery in some of those large cap tech names. Nvidia today rising, maybe some, I don't know, a little bit of light at the end of the tunnel in terms of supply chain issues for its Blackwell chip, where they've been laboring to produce as many chips as people want. We're going to talk about that a little bit later on. Otherwise, it looks a little bit mixed, but a decent amount of green on the screen.
I would check out, Apple's interesting too. So I know it's not a big move, but it was a big headline with a report that Chinese regulators weighing a probe into Apple's App Store fees. So certainly one to watch as well.
Did you just touch
I just
the
did.
Interactive?
Yeah, a bit of a Vanna White moment is what it felt like.
It was great. You did a great job.
You. Stocks searching for gains after earnings from Alphabet and AMD fell short of expectations. For more on the latest market moves, let's welcome in Chris Versace, Tematica Research Chief Investment Officer. Chris, it's good to see you. So just talking there to Julie about big tech. Alphabet is getting hit, Chris, and hit very hard today. I'm interested to get your reaction to that report. And that's just more broadly your take on big tech here.
So, the Google report I thought was interesting. You made some good points just now, Josh, about the continued growth in search, the continued growth in monetization in YouTube. I think a lot of folks were really thrown off by the somewhat softer than expected cloud revenue and that big ramp in capital spending. But candidly, I see it more like what we saw at Microsoft, that Google Cloud is likely capacity constrained. That explains the revenue number. It also explains the $75 billion in CapEx that they targeted, which, by the way, was a good 10 to 15 billion higher than what the street was looking for.
I'm also curious, though, about not just Alphabet and sort of particulars, but also the role of big tech in the market currently, right? Where there's been all this debate about the broadening in the market. We have seen some money go towards more value-oriented names this year amidst market turmoil. So sort of, I guess, is big tech still the fulcrum for the market?
I would answer it slightly differently and say, where are companies spending? Where are consumers spending? Where is stimulus dollars going? And when you look at it that way, you just take a look at the continued ramp up in capital spending that we've seen. You guys just rattled off some of them. So clearly big tech is going to be in focus. There's a lot of statistics out there at the same time that are pointing to higher AI capital spending inside of companies and adoption over the next 3 years. So I think that area for big tech, we're still in the early innings of that adoption. And then the ripple effect of that, carrying through data center, the need to build out electrical capacity and the like, that story very much intact.
Does it make sense, Chris, when you think about big tech CapEx, Microsoft and Meta, you heard Alphabet last night, does it make sense to you, all that spending?
I think it does. If we were further along, right, if we were in the 5th or 6th inning, I would be a little more concerned, right, that we perhaps we're overbuilding capacity and demand has to come up. But all the data that we hear about AI adoption, whether you want to listen to SAP ServiceNow or even some third-party studies, McKinsey has a great report out now, it's still, single-digit percentage of meaningful adoption. So as that moves forward, that is something I'll be watching for, the potential overbuild, double ordering, all those things that we tend to see.
What do you make of the view that investors are sort of viewing big tech as a safety play almost right now? That it's a place that is going to be safe and stable amidst what is sort of a volatile backdrop now, at least in terms of headline risk?
Well, I mean, there's a lot of going on, right?
Yeah.
So, the question on tariffs, the question on Gaza and what the response is to that, but even some of the economic data. I heard what you guys were saying, and you're right, the headline ISM services number, a little cooler, so we'll see GDP expectations, the few that we have based on less than a handful of data points come down slightly. But when you dig inside that data and you marry it with the ADP January report, jobs are growing faster than expected, wages sticky, if not trending higher. So the question is, what's the Fed going to do? So that's the overhang. So as an investor, you turn to something that has pretty good visibility, big tech or certain pockets of big tech. I think that makes sense.
Chris, speaking of economic data, you're still waiting for the big data point this week.
Friday, yeah.
Jobs report on Friday. What do you expect there? How important is that print for the market?
Well, I mean, look, the Fed is focused on employment and inflation, so therefore it is an important data point for us. Now, how big of a number will it be? Indications are you scan across the various PMIs, ADP, and other job data. I think the consensus number is probably a little light. To the extent it comes in stronger than expected, it's probably going to push back expectations for when the Fed may deliver a rate cut. Personally, I think it's at the soonest sometime in the second half of the year.
And so given all of these various cross currents that you just alluded to, so tech you say is one place to go, but I know you have some ideas about other sort of trades that people can employ if they're feeling nervous right now.
Yes. So one of the things that we did at the Street Pro portfolio that I manage is we actually put on some inverse ETFs earlier in the week, one for the S&P 500, one for the Nasdaq 100. So big tech, if you want to put it that way.
And so basically they just move in the opposite direction
Correct.
of where the index
and those are, to be clear, those are not investments, right? Those are hedging or tactical positions, very short-term in nature. And we did that because of what happened on tariffs. And if we saw China not respond the way they did, or this probe on Apple not come along, we might consider dialing that exposure back. But based on what we've seen, I suspect that we're going to see even more retaliation from the White House on this, and that'll set the stage for any tariff negotiations with the European Union.
Chris, what's demand been like for those products?
What do you mean? I'm not following.
What's the appetite for them?
For those kinds of
inverse
hedging strategies.
Yeah.
I can't really say, right?
Yeah.
I think in times of, when the market, S&P 500, Nasdaq 100 is extremely overbought, a lot of uncertainty in the market, I would suspect that demand is higher for those. We're not overbought, but there is a fair amount of certainty in the market.
And so spool out what you were starting to say a little bit. In other words, if you are hedging, what are some of the things you're worried about that you're sort of hedging against? Like, You mentioned the EU and a potential tariffs being imposed there. Like, what are the risks that you're potentially preparing for?
Well, I mean, first off, it's the overall uncertainty in the marketplace. And I think we have to recognize that President Trump is no stranger to uncertainty and keeping people kind of off balance as part of his negotiating tactics. So we have to be a little more mindful about trying to tamp down volatility. And that's really what we're trying to do. As far as things that could happen, well, I mean, if we see a big escalation in tariffs, either with China, what's the inflation impact on that? Right? What's the demand impact on that? What does it do to the dollar? So there's all these what I'll term as global macro risks that we want to pay attention to. And then, of course, as I alluded to earlier, there's this unknown or renewed unknown, I should say, about the Middle East.
Yeah, definitely a lot on the list right now.
A lot to read late at night, early in the morning.
No, that's not good for your mental health, Chris. Don't do it right before bed. Great. Thank you so much. I appreciate it. Good to see you. Chicago Federal Reserve President Austin Goolsbee weighing in on possible tariff implications for the economy and Fed policy in a new speech. Our Jennifer Schomburger here with the details on what he said. Hi, Jen.
Hey, Julie. That's right. Austin Goolsbee, president of the Chicago Federal Reserve, says President Trump's tariffs could create challenges for the central bank as officials are still trying to get inflation back down to their 2% goal. Speaking earlier this afternoon in Detroit, Goolsbee said, quote, "If we see inflation rising or progress stalling in 2025, the Fed will be in the difficult position of trying to figure out if the inflation is coming from overheating or if it's coming from tariffs. That distinction will be critical for deciding when or even if the Fed should act." This week, President Trump announced 25% tariffs on Mexico and Canada, only to pause them for 30 days. He also slapped a 10% tariff on Chinese imports, which remains in place. Inflation has shown to be stubborn absent the impact on tariffs. The Fed's preferred inflation gauge showed prices held steady in December from November at 2.8%. Goolsbee noted that passing over the threat of large tariffs and the potential for an escalating trade war and potential consequences would, quote, be a mistake. He says while a one-time tariff without retaliation could be transitory, the key for inflation is whether there are substitutes to the products, parts, and components being tariffed. If companies diversified their supply chains over the past 5 years because of the pandemic, that could make them more resilient and allow them to avoid tariffs. But if there are components and parts that are coming from China that cannot be substituted, then the potential impact is going to be much larger. Now, Goolsbee thinks that manufacturers in this country are not going to be able to pass on the bulk of increase in costs to consumers, which means that could hurt margins, and in some cases, he thinks there could be bankruptcies. I will be speaking with Goolsbee this Friday live here on Yahoo Finance at 10:30 a.m. Eastern on the back of that jobs report for his reaction. Guys?
Looking forward to it, Jennifer. Thank you. We're just getting started here on market domination. Coming up, big spending has been the big theme for big tech thus far in 2025. We'll be joined by an expert on the other side to break down the numbers and the outlook for CapEx. Stick around, much more market domination still to come. We're in the thick of earnings season, and an emerging theme, the eye-watering numbers that big tech is anticipating to spend in 2025. The latest name from the Magnificent Seven, Alphabet, reporting that it is expanding its capital expenditures for the year to $75 billion. For more, we're bringing in Futurum CEO Daniel Newman. The numbers are big, the increases are big, and there doesn't seem to be any appetite to slow any of this down.
Fear not DeepSeek is what I would say.
Yeah.
We heard that come out and everyone's like, it's the end. And I think the people that are really in the know realize it's the beginning. That's why none of the forecasts, whether it's been Meta, whether it's been Microsoft, whether it's been Alphabet, all of them have really stood by their expectations to invest. It's because we are entering era 2. We went from this pre-training era where there was this one big infrastructure buy that this is what everyone could understand. Now we're entering the inference era, and these companies have to build out the capacity to do trillions of concurrent tokens for these workloads. And this pivot is big, and these companies don't want to fall behind.
Let me ask you, what did you make of one thesis out there, which was that if we're going to have cheaper or open source models, that means, okay, app makers, software firms, it's going to be that much easier for them to make these AI apps, right? You're going to see a proliferation of those, and that is good news for an Apple, for example. What do you make of that argument?
The consumption is the real theory here. I mean, look, we've been waiting all year for this AI ROI story. And so we have to move from infrastructures to platforms and applications. That's kind of the way things flow. What we got out of this whole story was it's going to happen faster. I mean, look, there's a lot to unpack with DeepSeek. There's still a lot of question marks. Was it half a billion? Was it $1.5 billion they spent? It wasn't 6 million. Okay, that we know for sure. But having said that, what we do know is that there's this massive desire. So you've heard companies like Qualcomm and ARM both reporting today kind of come out. They're very enthusiastic about it. Why? Because if we find cheaper inference and more of it, people are going to want to do it on device. That's good for handsets. That's good for PCs. App makers, Mark Benioff was thrilled. You saw some of the tweets that he put out about it. That's because if we have more agents and this becomes more affordable, it costs them less to build it. They can pass it on to consumers, and consumers can go from, about 98% of companies are doing some type of POC for AI, but only 25% has scaled it.
POC?
Proof of concept. Sorry about that. And the bottom line is that none of this is, I would estimate we're at about 1% deployment of the potential of AI. I mean, we have hundreds, if not thousands of times orders of magnitude more AI to do. We're just in the beginning. This CapEx build out has to continue. And that's why all the Nvidia fear, I just don't buy it.
Okay, so here's a question I have for you. We have a chart looking at the CapEx percentage increases that are planned for this year, either that companies have told us or that are estimated. That's clearly the white line there. The green, though, is the expected revenue growth this year for these companies, which is in the teens. But guess what? If you look at next year, it's in the teens. If you look at the year after that, it's in the teens. Where is the return on this investment?
I love it. I love the enthusiasm. Look, I feel the exact same way. I've been putting the question mark out there about AI ROI. We've got to get to these applications that people can consume. It's consumption. Look at this Apple moment. Hasn't happened yet. This AI PC moment hasn't happened yet. There's excitement. It's oh great, I can run a model locally, right? That's what we were just talking about. But where does money get made? So if you think about an agent, right? And people talk a lot about agent force. I'll just use that example, right? Or Copilot, both of those things. Every time someone pushes that button, there's an opportunity to monetize. Right now, it's very little. We're hearing very little. Microsoft spending $80 billion to make 13. But companies are doing this, hundreds of times, thousands of times. They've deployed it to 1%, 5% of their workforce. If they can get this deployed to 50% of their workforce and then get those pennies per action at scale, that's where I see it happening. It has to be consumed in the applications.
Isn't the real opportunity, though, is not in the enterprise? There's only so much you can do, and then doesn't it have to be consumer at some point to really unlock the value for this thing? And I don't know.
Yeah, there's different business models. Actually, that's a great pivot. So you look at Google and Alphabet, why it's under fire right now. I mean, it's got a whole bunch of antitrust things, but I think most people in the world are asking the question is, does search look like search in a few years? I think all of us that are using an OpenAI tool, that maybe they're using Gemini, you're how do they integrate this? Do people stay on the platform? Does the Apple install base and the built-in Android install base turn to money? The advertising model has to change. I think there's an attribution model, and I think if people are doing billions of searches, and it's creating pennies, nickels, dimes. But I think this is a scale play. I think a lot of people, to your point, I do think there's money to be made in enterprise. There's always a lot of profit in enterprise. Having said that, adoption hasn't happened yet. That goes back to the AI PC, back to the iPhone. We need the adoption, then they come. That's how the App Store worked. It wasn't always such a boon for Apple, but now it is. It's the biggest lock-in, it's the biggest moat, and that's why nobody's selling, or a little bit of selling of Apple, because they know long-term, Apple doesn't have to get AI right away. They've got the install base, and as long as they got the install base, they'll turn it to money.
Pushing ahead a little bit. So Alphabet is getting nailed today, right?
Yeah.
It's mixed results. It was actually solid search, but cloud softness. Do you see that, Dan, and is that a yellow flag to you for Amazon's report tomorrow after the close in their cloud business?
Yeah, we saw with Microsoft, then we saw it with Alphabet, and it goes back to our point about AI ROI. Yeah. People are like, they're spending all this CapEx, they're growing at 30%, but they were growing at 30% before we were talking about AI. I think there is a worry there. I think them figuring out how to turn these platforms, build these applications, and monetize. You were absolutely right, Julie, about the whole thing. It's just, I think it's gonna happen faster. I think everyone's a little bit more conservative in their forecasting, and rightfully so. There's no benefit for most of these CEOs to forecast ahead of what they know for sure. They can always hold back a little bit and get more aggressive. I think we're seeing a moment, we're seeing AI move to the edge, we're seeing consumption grow. I'm very bullish about it, but just like you both, I want to see the proof too, in order for me to start believing that this pivot is actually being made.
Well, we'll keep waiting until we get it. All right, thanks, Dan. Good to see you. Thanks for coming in.
Good to see you.
Now it's time for some of today's top trending tickers. First up, we've got to look at FMC Corporation. Those shares plunging as the company's forecast disappoints and fuels some growth concerns. What is FMC, you might ask? Well, guess what? It's a huge maker of insecticides, crop protection products, as they call it. They sell those products all over the globe. And FMC is actually in the S&P 500. It is the worst performing stock in the S&P today. Listen to this. The company's forecast for the full year for adjusted earnings per share is at most $3.70. Analysts had been looking for $4.40, Josh.
Yeah, this one is trading at the lowest intraday level since 2016. CEO is saying the company needs a stronger reset than what I thought initially. Analysts are weighing in. RBC downgrades it to sector perform, talks about how the Q4 was solid, but weak organic growth, Forex headwinds. Morgan Stanley cut the target to 46. Doesn't think investors, they say, re-engage with this one until they show they can reach 2025 EBITDA guidance of between 870 and 950 among other bogeys they're looking for.
Yeah, I mean, this has a lot to do with what's going on in the agricultural markets. Crop prices falling. There's also, of course, concerns now about tariffs and whether that's going to weigh on the market. The CEO of the company, Pierre Brandreau, said the company needs a stronger reset than what I thought initially, and it sounds like investors were listening to that message.
Moving on, turning to the chip space, Supermicro Computer announcing full production availability of its AI data center powered by Nvidia's Blackwell platform. So new AI data center systems powered by Nvidia's Blackwell chips are ready to ship, Julie. Company saying the product has reached full production availability. So some good news for this name, which is good because there hasn't been a ton of good news. It's been a rough stretch.
Yeah, the stock has really been very turbulent. Of course, there were allegations by a former employee that the company had overstated some of its numbers. It was targeted by Hindenburg Research. The short interest is still about 16% of float. So you see there could be some short squeeze today. But really what this speaks to, as much as it speaks to Supermicro, it speaks to NVIDIA as well. As we know, one of the bottlenecks, one of the issues, one of the concerns about NVIDIA was its ability to produce as many Blackwell, of the most advanced Blackwell chips, as people wanted. So this is a sign that it is getting Blackwell out the door via Supermicro products. So it's helping lift NVIDIA today, as well as helping lift those shares of Supermicro.
Yep, and meanwhile in the retail space, check out shares of Capri Holdings. They're under pressure after third quarter earnings missed estimates. Company's outlook for fiscal 25 and 26 also disappointing. Wall Street, we're down about 11% in today's trade. Stocks dropping. Guidance was below estimates. This is the parent of Michael Kors, among others. CEO saying we expect our performance to improve throughout fiscal year 2026, positioning us to return to growth in fiscal 27 and beyond. Does see fiscal 26 revenue of $4.1 billion. That also did undershoot analyst estimates.
And remember, of course, Capri was going to try to combine with Tapestry, the owner of Coach, but that deal was rejected by the FTC, and so they abandoned that deal. But I mean, if you look across the different business lines at Capri here, Kors down 11, almost 12%. Versace down 15%. Jimmy Choo was a bit of a bright spot, up 4.2%. But Anisha Sherman over at Bernstein pointing out there were 6 quarters of no guidance because of the pending deal with Tapestry, and now you get this disappointing guidance after not getting it for so long.
Stock is now down about 50% over the past 12 months.
Yeah, and let's also take a look at shares of Big Bear AI. Those shares surging. It's receiving a Department of Defense contract to enhance its virtual anticipation network for geopolitical risk analysis. What the heck does that mean? Basically, they signed a contract with the Department of Defense. And like SMCI, Big Bear is kind of meme-ish, I would call it, you know.
What a move for this name.
I mean, what a move indeed for this name, right? And this one also is a heavily shorted name, so you get a little short squeeze here.
Yeah, it didn't look to me, Julie, like we had, you know, they did secure this, the U.S. defense contract, and obviously people were excited. I didn't see terms of the contract, but maybe just the news and the headline was enough. Stock's up around 330% over the past 12 months.
And P.S., this company doesn't really make money. Like, its revenue this year is projected at $168 million, million with an M. Like, it doesn't bring in, not even does it not make profit, it doesn't, right? It has net losses. It doesn't even make a lot in revenue yet. It's early stage.
Believers today, hopping in.
Yeah.
Coming up, Disney topping estimates in its latest earnings report. So why are shares lower today? We're going to hear from one analyst on the other side of the stick around. Much more market domination still to come. Gold prices continued their record run, the precious metal hitting a fresh record amid concerns over trade wars. Here with more is Yahoo Finance's Inez Ferre. Inez.
Yeah, Josh, and as you just mentioned, gold hitting new highs. We saw spot gold hitting new highs. Also, futures for April delivery also hitting new highs. We saw it go all just up above 2,900 per ounce. If we take a look at a year-to-date chart, you're looking at gold up about 8.5% year-to-date. A lot of this has to do with tariff uncertainty. But over the last year, we've had really geopolitical uncertainties. Last year, you also saw the Fed that was cutting rates. That spurred some gold buying as well. And if we just take a look at gold demand, the World Gold Council has put out a chart on gold demand. And you see here that in 2024, you have record demand for gold, driven a lot by central bank buying. A lot of people saying central banks trying to get from out under the thumb of the US dollar. Central bank buying, which accelerated in the fourth quarter of last year. So this green part is the fourth quarter of last year. Q1 to Q3 is this blue part. And this white line here is the gold price. So you saw gold prices going higher and higher, hitting all-time highs as central banks kept on buying. And also you saw inflows into gold, physical gold-backed ETFs. So you saw also Western investors getting in on the action as the Fed was cutting rates. Will we see record demand for 2025? Well, some say that central bank buying is structural now. Goldman Sachs saying that this is a structural change now, that central banks will continue buying. But whether or not you have Western investors buying, well, a lot will depend on what the Federal Reserve does this year, if it resumes cutting, and of course, with tariff uncertainty in U.S. policy. Guys?
A lot to consider, as always. Thanks, Inez. Appreciate it. U.S. crude oil stockpiles on the rise, increasing by 8.7 million barrels in the week ended January 31st, according to the Energy Information Administration. Oil prices sliding today as traders watch those inventories, plus the news flow on tariffs and the Mideast, now Russia. CIBC Private Wealth senior energy trader Rebecca Babin joining us now to discuss a lot of geopolitical headlines that people are now watching, Rebecca. I actually want to start with the last first, because the Russia situation, I know it's something you're watching carefully. There is some reporting that the Trump administration is expected to come out with some sort of proposal for some sort of plan for Russia and Ukraine next week. What are the dynamics in terms of Russia in the markets right now, and how that could maybe help or change those dynamics?
So that's a great question. Right now, Russia has been kind of under an increased sanctions pressure since late December. The last thing the Biden administration did when they left was to expand their sanctions profile against Russia, and it included many more tankers, a lot more insurance companies, and the market has really pulled back on being very afraid that we were going to lose supplies. Keep in mind, there have been sanctions on Russia since 2022 under the price cap, but the flows were still moving, right? They were able to work around it. It wasn't heavily enforced, but this last round really caught people by surprise. And most importantly, what happened was the buyers of Russian crude, India and China, knowing Trump was coming in after this announcement, stepped back and said, you know what? We're not going to offload those barrels until we understand what's happening. This tightened the market, and it also drew in a lot of money. So the market went from being very neutrally positioned it's kind of in early December to very long at the end of December and into January. So that dynamic is what really pushed the supply risk. Up until then, we hadn't seen much impact of sanctions on Russian flows, right? They're kind of working on their shadow fleet, trading around the price cap. The barrels are still there. This was really the first time people were concerned about the barrels moving off. A potential peace plan or steps towards a peace plan obviously kind of takes away that potential supply risk. Not that it's going to go away, but maybe they get an extended timeline of when it comes on. Maybe there are waivers, right? So if you were in the market because you're like, okay, we're going to lose 500,000 barrels of Russian crude, you look at that headline, you say, I don't know if I want to price that in. And guess what? I also have to think about what's going to happen with tariffs on China and if that's going to hurt demand, and my conviction is lower. And we saw $17 billion come out of oil and fuels over the week ended January 31st. This had a major impact on positioning. And then we've broken some technical levels, and that drives the CTA and systematic flows to kind of abandon their long positioning. So it's It's been a week.
Wow.
Can I ask you about also Iran there as well, Rebecca? Because Trump, on the one hand, he talks about maximum pressure. On the other hand, he's put out some posts on media seem to kind of want to downplay the tension. How are you thinking through that dynamic in your market?
Well, that's a really tricky one. So I think two things. First, maximum pressure isn't a new idea. That was kind of a little bit priced in throughout the campaign and on the whole notion that Trump might win the election, right? He used maximum pressure in his first term. So as soon as he won, there was a pricing in like Iran is currently exporting 1.2 under maximum pressure. I got to at least price in, we're taking 500,000 barrels off, right? That's going to be his day one. The fact that he's walking it back a little bit, there's a lot of skepticism on whether they can actually reach anything, but the idea that diplomacy is really on the table, again, takes away that maybe it's not 500,000 barrels we lose, maybe we lose 300,000, maybe it's a longer timeline, right? So if I'm playing the market on supply risk being the driver of upside, I've lost a lot of that conviction this week. And if there's a lot of concern about the demand side, the buyers who would normally come in and buy that dip on fundamentals, supply and demand, might not be as convicted because we're worried about tariffs.
So putting all this together in sort of layman's terms, it means that there could be more potential declines in the price of oil if this continues to play out as it has been.
I think that's what the market is seeing over the long term. In the short term, though, I want to be very clear. There still could be supply disruptions, right? Just because we come to the table, who knows what happens, and he might have to use the stick and actually enforce these sanctions to push the negotiations along. But right now, the market is in such a short term, I can only survive till the end of today in mentality, right? So they're like, okay, this is a less supply risk. I'm going to take off some risk. I don't know if I don't feel as strongly that it's going to come to fruition in the very short term, right? So it's this very, very fast acting kind of, okay, what is the headline today? Do I have as much conviction as I had yesterday that we see supply losses? We need to be very careful, though, in saying these risks are gone, right? These risks are being reduced, priced slightly less in the market. They're still very much there. But I think if we come back to fundamentals, if you're a fundamental guy, you're still looking at this and saying, I'm scared about China demand. I'm scared about what these policies mean for the U.S. I don't feel good about how much global demand there is versus supply. I don't know if I want to buy this until I see the 60s.
So, Rebecca, so when you look at Brent, just bottom line, 74, 79 here, and your clients ask you, Rebecca, where's that headed 6 months from now, 12 months from now? You're telling them what?
So I tell them this is going to be volatile, first of all. So this is going to be a moving target because almost every policy that we're dealing with right now has a feeler into crude. So I think the kind of 70-80 range in Brent is something I'm comfortable with in terms of saying this is going to be the range. I think when we get above 80 and those kind of, we could obviously pop above it, right? This isn't a concrete wall, but above 80 Brent, I think that's where you start to see OPEC be more engaged with bringing back supplies, right? Keep in mind, spare capacity from OPEC Plus is the buffer that keeps crude from spiking to 90, right? They have 5 million barrels of spare capacity on the sidelines. They want to unwind. They want to bring back production, but they want to do it at the right time. And I think when you see prices move steadily above 80, they're more incentivized. Below 70, we start to lose some production from the U.S. We see maybe some money go to the SPR to refill. So, again, that's all in the confines of the economy being in a somewhat good place. So 70 to 80 is kind of the range, but be prepared for a spike to 65 and a spike to 85. But that's where I think we kind of settle out.
Well, and Rebecca, since we don't get to see you in person very often, I'm curious to put all this in perspective for us, because you seem very, head on a swivel, I guess, as some traders say, right? There's a lot going on. Put this in perspective for us, because you've been doing this a long time. Is this period unusual in terms of the volume and velocity of headlines and potential outcomes for the market?
I would say yes. I would say this is unusual. Now, during Trump 1.0, there was some of this as well, right? You had to wake up at 2 o'clock in the morning and look at your Twitter feed, right? It used to be Twitter. So it's unusual, especially when we put the last 4 years into context. It is probably, I'd say, more than I experienced with the first Trump administration, simply because we have more things in play. Right? Almost every geographic region is in play. Canada's in play, right?
Who thought that?
Right? So there's it feels more because there's the implications. It's a global market, and you impact one thing here, you impact something else there. So yes, I think it is true. It's more volatile. You have to be faster. You have to be more nimble, and I think that's why you're seeing the outflows. Right? It's really hard to calibrate it.
Thanks so much for being here. It's great to see you.
Good to see you too.
Well, Disney shares are lower today despite the company beating earnings expectations this morning, with profit in streaming offsetting some of the losses in the parks business. Earlier, Yahoo Finance executive editor Brian Sozzi sat down with Disney CFO Hugh Johnston to discuss the results. Here's some of what he had to say.
We're doing a nice job of eliminating unnecessary costs and at the same time investing back in the business in all of the right ways. And what you're seeing out of it is obviously terrific content coming out of the studios, whether it's Moana 2 or Mufasa or earlier Inside Out 2 and Deadpool. ESPN obviously had a terrific quarter with the college football playoffs as well as the SEC. And Experiences had a better than expected quarter in many ways. Despite the fact that we had hurricanes, the business was flat in line with the guide, and that was up about 6% from an operating income basis. So overall, the company's really firing on all cylinders right now, and I think we're fueling it well to continue to see that performance.
Joining us now, Laura Martin, Needham & Company Senior Media and Internet Analyst. Laura, it's great to see you. So
nice to see
you
you.
Just heard Hugh there. He makes it sound like everything is going fantastically well. I guess the shares today not necessarily reflecting that, but I know you're a bull on the company as well. What do you think that investors are missing here maybe in what we heard from Disney?
Well, I think what's driving shares down is they lost subscribers at Disney Plus, and they've said they're going to lose subscribers next quarter too. And they've made the choice to raise the rate, the average monthly rate, which is always hurts your subscriber growth, supply and demand. You raise price, demand goes down. And they're saying, hey, it's inelastic demand, so we'd rather take the profit growth. They over-delivered the operating income, so the profit number by 13% in the quarter. So Wall Street loves that. But on the other hand, we really don't like shrinking installed bases. And so although Disney Plus Hulu grew 900,000 subscribers, Disney Plus alone fell 700,000 subscribers. So we don't like this notion that maybe the Disney Plus service isn't growing anymore. The point I would make is that when you look at linear TV, which also fell like 7%, which isn't great, and its profitability fell 11%, when you add linear to the streaming, that is now crossed over so that streaming has gotten big enough that together they made about $1.7 million of operating income, and for the year they'll do $4.5 million. So linear is no longer a negative pull on the revenue line. It just sort of offsets the streaming business, which means that as streaming continues to get larger, the negative growth of linear TV will be less important every quarter.
Laura, kind of a broader question about the streaming wars and the competitive landscape. I mean, you've seen lower Netflix and the numbers they're able to post at this point. You know, is Disney really, is it fighting here for that silver medal, Laura? Which is okay. I mean, listen, second place, you can still make a whole lot of money. But is that how investors should think about them?
Yeah, in a way, they're sort of different business models because, as you know, Netflix essentially has a single release window. It makes stuff, really just releases it to streaming. That's its entire revenue stream, and it does that globally, 196 countries. That isn't Disney's model, nor has it ever been. As you and I know from many years of covering Disney, they have a huge film like Moana, and they put it through the theater, and they put it through their theme parks, and they put it through their consumer products, and they happen to put it through streaming. So Disney gets a lot more sort of bites at the apple, and they run a much more, like I would say, efficient business model. But they do have things like parks, which are much more capital intensive, but it is driven by the success of their film business. So Disney continues to have, let me call it 4 or 5 windows of ways to make money from their film business. That isn't the business Netflix is in. They only have one window, and it's streaming.
But it sounds like from what you're saying, though, that Disney sort of has reached a tipping point from a profitability standpoint in streaming, and that is a reason to own the stock.
Yes, like I said, I think linear is going to be less of a drag over time as streaming continues to grow, and they will go global, right? They're following Netflix into those countries. I think they're in 22 countries right now, and Netflix is 190. So, I mean, over time, the Disney streaming service will become more ubiquitous, and just as Netflix has done.
We talked a lot about streaming, Laura. I just want to dig into the parks as well with you. Operating income there, $3.1 billion from the experiences division. That looks little changed from last year. What do you see ahead there, Laura?
Completely flat, and they also guided to 6 to 8%, which is the same guidance. But the thing is, they had 2 hurricanes. I don't know if you remember that. They had these 2 hurricanes, and then they also launched a big cruise ship. And the way the accounting works is you have all these marketing costs to get people to fill up your cruise ship for its first, maiden voyage, and those all hit the P&L before you get $1 of revenue, which is in the subsequent quarter. So we had 3 sort of one-time only, 2 hurricanes and the cruise ship launch, all hitting the P&L. So that's why the 3.1 billion was flat. It would have been up 6%, which is in line with the revenue growth, if they hadn't had those 3 things, which we should assume are not recurring next quarter.
Laura, switching gears here to another name you cover, Apple. That headline, Laura, we saw, the report that Chinese regulators kind of weighing a probe here into Apple's App Store fees. How concerned, Laura, should Apple investors be about a headline like that?
So I think that the major concern is that China isn't going to roll over and play dead on tariffs. That's number one. And then second, the way China is going to try to get back at the U.S. is it's going to use people like Disney and Apple, who actually have assets sitting in China. So the retaliation affects like individual stocks. And like they're going after Google for antitrust, but like Google doesn't do anything there. So it's hard for the Chinese government to hurt Google, particularly because they don't have search assets there. So unfortunately, I think both Disney and Apple are exposed to Chinese sort of viewing like those as American companies. But I don't think Trump views those as American. I mean, he doesn't view those as the like standard bearer of America. China views it that way. So unfortunately, they become pawns in this tariff war that really Trump has started.
Well, Laura, these companies that you mentioned, with the exception of Google, which, as you said, doesn't really have a business there, but like Apple and Disney have deep, deep connections and experience in China, and they have been, in the past, become pretty adept at navigating, right? But is there anything that they can do to adapt in this sort of situation, or is it sort of out of their hands and a risk that investors need to consider right now?
I mean, I think it is a risk that they need to consider, but because I think it's like bigger than Tim Cook has a good relationship with his Chinese counterparts. This is China moving, chess pieces on a board in response to, getting tariffs levied on it. It's trying to figure out how to get even. And so it's looking at American companies as a way to get even. So I don't think, I think these are bigger chess moves than a relationship that China has. Already, you saw that Chinese sales of iPhones in the quarter just got announced were down 11%, and the prior quarter they were down 2%. So that's a material injury to the revenue growth line for iPhones of Apple. So it's already started to have a negative consequence, the Chinese sort of lockdown, and that was in response to the TikTok ban. So now we have tariffs. So now, unfortunately, here's Apple in the way of this Chinese geopolitical tensions they have with the U.S.
Yeah, we'll keep on watching it as we watch all the headlines. Laura, thank you so much. It is great to see you.
Nice to see you. Bye-bye.
Stick around. We got much more market domination still to come.
From Trump policies to earnings, investors have been navigating several headline risks to the first few trading weeks of 2025, yet index volatility trending lower so far this year, despite the recent roller coaster ride in markets. What does this mean for options trading? RBC Capital Markets equity derivative strategist Amy Wu Silverman joining us now to discuss in the Options Pit, sponsored by Tasty Trade. Amy, it's always good to see you and have you on the show. So a lot of big, powerful headlines, Amy. I got tariffs and earnings, got DeepSeek. Walk us through how is the option markets taking it all in, Amy?
Yeah, it's been pretty incredible, right? Because the options market has actually been relatively sanguine. And just if you actually look at close-the-close VIX, despite all the headlines you just mentioned, we haven't even surpassed that psychological 20 barrier. And, you know, I have been joking that this is a paddling duck market, so it kind of looks calm and smooth on the surface, but those little duck feet are furiously paddling underneath. You know, a lot of this has to do with the sector rotations we see, and a lot of it has to do with index volatility suppression that kind of belies what's actually underneath.
So I guess that begs the question, if we're not seeing that volatility on the surface, if it looks serene, where are those feet furiously working the most? Where are we seeing volatility pop up in reaction to all of these headlines?
Yeah, it's, you know, so I'll throw out one technical term, but I'll kind of explain what I mean. So the dispersion in the market is really high right now. And all that means is you essentially have some sectors going one way and other sectors going the other way, and it has this effect of canceling out on an index level, but it doesn't mean that there aren't those violent rotations. So just two really simple examples. You know, we've seen drawdowns in the healthcare sector, but we've seen rallies in the financial sector. A lot of that has to do with who Trump picked for cabinet positions, but obviously other idiosyncratic risks as well. But what you get is kind of this elevated single stock volatility, but you don't see it on the VIX because the VIX is ultimately just a weighting of S&P options, not necessarily of those single stock or sector level options.
So Amy, so very high dispersion. Appreciate you walking us through that one. You're a fundamental investor. You're listening to this right now, Amy. What do you do with that information?
Yeah, it's a great question. And, you know, sometimes I throw out those words dispersion or correlation. It puts people to sleep. But the reason I think it's really important is, you know, you as a single stock investor actually can make a lot more money in dispersion environments than you can where everything is very like macro and correlated. And what I mean by that is that stock picking, that sector you choose really matters. So just again, to go back to that simple example, if you had put everything in financials versus everything in healthcare, you know, what your choice is, what those fundamentals you pick matter a lot more now than if correlation were really high and we were actually only moving on rates or only moving on macro news.
And so where are we seeing a lot of the options activity go, in this dispersion market, right? I know that there's been, for example, a decent amount of call buying in big tech, but if you are a fundamental investor, do you have areas where you think that people should be looking?
Yeah, so two things I'll say. The first is we've seen this very interesting dichotomy between what institutional investors are buying and what retail investors are buying. That's first. And then second, you know, we kind of had this post-COVID period where essentially everyone was trying to buy calls, particularly in the AI names or the mega cap tech space, because they all wanted to be participating. A lot of that has gone away just because of positioning, because people are quite long. So what we are seeing is we are seeing increasing rising and hedging demand. Part of that is just simple macro uncertainty, and part of that is just positioning. It's just people have more to protect right now. You've had 2 consecutive up years in the S&P, and so there is this natural inclination to say, hey, I kind of want to protect my gains in kind of this third year. We don't know what's going to happen.
Amy, always good to see you and have you on the show. Thanks for joining us.
Thank you.
And while wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime, sponsored by Tasty Trade. Let's see where the major averages ended the session here. We had a mixed picture an hour ago, but then in the last hour of trading, we saw the Nasdaq turn positive. It finishing higher by about 0.2%. The S&P 500 up 0.4, and the Dow leading gains up about 317 points. That's about 0.7%. Couple different cross currents today. There were disappointing cloud results from Alphabet that really dragged down those shares and put pressure on large cap tech for much of the day before that late day recovery. We also had yields moving lower in the bond market. That seemed to give some relief to stocks. And then, of course, we had still, besides big tech, a lot of earnings in other areas as well. So we saw a lot of movement on that front that helped support stocks to some extent during the session. So that's what we saw sort of on the headline level here as we saw some big winners and losers within the tech space specifically.
All right, we are just now seeing Qualcomm earnings cross the wires. Let's get you those numbers. Qualcomm, Q1, adjusted EPS clocks in at 341. The street was at 297. Q1 revenue comes in at 11.67 billion. The street was at 10.93 billion. So those are beats on the bottom and the top. Let's spin ahead. Q2 EPS, Qualcomm is saying to look for between 270 and 290. Street was at 269. And for revenues, they're guiding for between 10.3 to 11.2 billion. The estimate on the street was 10.35 billion, Julie. Right now, stock right around the flat line here.
Yeah, the stock not moving, well, kind of bouncing around, I guess, today. Qualcomm, of course, still gets its bread and butter from its handset business, its mobile business here, but has been seeing bigger growth in Internet of Things and its auto business, which are smaller but growing areas of its business. So I'll be interested to get a little more color on those individual lines of business to see how they did, and also to see what the company has to say about AI. But I'm just looking for more information in the release, which I don't have.
Some big, now we're down about 2% here. We'll see how this shakes out. Some bigger questions I know investors are going to have, certainly on the call. They always want to get executives' thoughts about the smartphone market. How do they see that shaking out over 2025? What does growth look like? Apple and Samsung, those are different puts and takes to consider. The competitive landscape is going to come up. You know, I know some analysts on the street do have questions about MediaTek. Are they getting any ground? Tariffs, could that impact the business? That'll be front and center. And what about these reports that Apple, its in-house modem system debuts this spring? You would expect that to come up, and how are execs at Qualcomm thinking through that too?
All right, now I got some stuff from the release here from Cristiano Amon, the CEO. He talks about quarterly revenue records, and on the point that I was just talking about, he said, we remain committed to executing our fiscal 2029 targets to achieve $22 billion of non-handset revenues as they continue to diversify away from that handset business here. So the handset business in the quarter saw a 13% increase to a little over $7.5 billion, $7.6 billion to be exact. The automotive business up 61%. To $961 million in revenue, and the Internet of Things business up 36% to about $1.5 billion. So the total revenues there of about $10.08 billion. So again, as I said, seeing that more rapid growth in the non-handset businesses, even as it's still seeing year-over-year growth in its core business.
Yeah, and to your point, I think another question is going to come up is what kind of traction they're seeing in PCs. Also, what's the impact from winning that ARM lawsuit? That'd be another big one.
Most definitely. All right, stocks did jump with the gains in the Dow led by Nvidia. The tariff-induced volatility taking a backseat again today. The Dow and S&P 500 posting back-to-back gains. Joining us now, Ryan Dykmans, Dunham Associates Investment Counsel, Chief Investment Officer. Thanks so much for being here. So as we looked at the rally today, we were talking a little bit about how maybe yields coming down were a catalyst, but I'm curious how you see the setup in the market right now and whether you do think the risks are sort of tilting more bullish or bearish.
Sure. So, I'll start off by saying we see risk as being not very well compensated, right? The valuations that we're paying right now to get the growth that people are excited about for 2025, I feel like when you put a risk premium on that, I don't know if we're really hitting those numbers. So I don't think you're getting compensated for risk, and therefore we've been trailing back a bit on how much we're allocating to equities across the models where you can do that. I would say to the levels of being half exposed to equities where we can.
You have your very own quantitative model over there, Ryan. I'm just curious if you could walk us through that model. You know, what's it measuring and what's it telling you?
Sure. Yeah, so it's looking at market values over time. It was developed, you know, with a very long, obviously every model starts with the back test. But the idea behind it is looking at valuations, and it's looking at versus historical movements. So basically, you know, if you're looking at choppiness in the markets, it's looking at those opportunities for, you know, periods where we get a drop at whether it's 5, 6, 7%. Appears to buy in, and then obviously when it runs back up, appears to sell out. And it's not one of those that's a complete binary on-off. It's actually dialing in, dialing out. You know, the cheesy thing I like to say is I like to be generally right than precisely wrong. So I'm not trying to pick tops and bottoms, just trying to release some of the, I'll say some of my equities as the prices have been going up and buying bonds, because I am excited about the bond market going forward from where we're at today. Exactly you said, with yields poised to drop a bit, we'll see.
Well, let's dig a little bit more into the dialing back in stocks that you described,
Sure.
that you're not getting compensated properly for risk right now in the equity market. What are the risks that you're most concerned about, you know, that could be potentially cause hits to the market?
Sure. So, I mean, large growth is one of those areas where I would say we see the least compensation for that risk. So we have, that's where we've dialed back the most. So not only within my equity allocation have we been dialing it down altogether, but our actual exposure to growth is substantially lower than, I'll say, most of my peers, and also than the S&P, just as a broad kind of, you know, broad benchmark. But the risk that would topple that, obviously at some point, you know, these themes that people have priced in and said, hey, we think these are going to live on forever. That's how they're basically pricing a lot of these companies. I think that eventually you get a reality check, you know, and sometimes it's from an external force, you know, something like a DeepSeek comes out and says, you know, hey, there's another way to do this. Sometimes it's through retaliation through the tariffs, right? Something like that can upend some of these companies. I'll say the trend that people have bought into.
Within your U.S. equity allocation right now, Ryan, how exactly are you allocated?
Sure. So, you know, less than a quarter of it actually is going to be dedicated to, we'll say, pure large cap growth, which means that we're looking at almost 80% towards those other asset classes. So when people talk about breadth and the idea that, you know, small caps will have their day, and, you know, I'm one of those people that pounds that table, but value, you know, value is also something that's been underrepresented in most portfolios. We're very heavy on value. We see value stocks as an area that, you know, not necessarily it's going to be 2025 is going to be the year, but we do see it as a good, I'll say, return for the risk we see behind it. So going back to downside, I think large cap growth has a long way it could fall. I think large cap value, you know, maybe looks a little more attractive in that realm if we do have a sell-off.
And Ryan, turning to the bond market, I got to be honest, we don't meet too many folks who are enthusiastic about the bond market these days, which I think is what you just said a few moments ago.
Sure.
You know, there are a lot of risks potentially to the bond market as well, right? Whether it is that the Fed is not going to cut anytime soon, whether it's that we are going to see some upward pressure on inflation. So why do you like the bond market here?
Sure. So actually, it's funny you ask, because it's one of the first searches I did when I did a manager search was in the bond market. So I was looking at bonds before even equities 20 years ago. And so when I did that, one of the things I loved about it is there's so many different facets. I mean, you talk about equities, people generally hit your small, large value growth. In bonds, there's thousands of instruments to play with. So we've actually, within high yield, that's one of the areas we have our largest weighting. So we have about a 40% weight in our high yield kind of exposures, mainly because we don't see credit risk as the looming risk. It's more about rates, right? So keeping a lower duration, lower interest rate sensitivity, and getting paid a little more for it with a higher coupon, we've been liking high yield. But alternatives is the other spot that we have been really excited about, specifically fixed income alternatives. We do include event-driven investing like merger arbitrage in our fixed income alts. But we also use things like long-short credit, basically the ability to dial back both duration risk and credit risk and still collect that yield. So just looking for things that don't behave like necessarily the rest of the bond market, like the, you know, Bloomberg Ag might behave. We aren't necessarily tracking that exactly. We're looking for just, you know, capital preservation, positive returns. That's why I'm excited about it.
Gotcha. Ryan, thanks so much. Appreciate your time.
Thank you for having me.
More earnings to get to. ARM just out, and those shares down a quick 6% after that company came out with its numbers. Its numbers, by the way, that look okay at first glance. Third quarter adjusted earnings per share, 39 cents. That's versus the 34 cents that analysts had been anticipating. It looks like royalty revenue beat estimates, as did license and other revenue. The company's forecast for the fourth quarter, its fiscal fourth quarter, $1.18 to $1.28 billion. The midpoint of that is in line with the $1.23 billion that had been estimated. But given maybe some of the estimates, some of the enthusiasm around ARM, which has more than doubled in the past year, perhaps those numbers, Josh, were just not good enough.
Yeah. Listen, we care about ARM because it is one of the most important semiconductor companies on the planet, full stop, makes money by licensing its chip designs. You're going to have a lot of questions on the call. I'm curious to hear more about all their end markets. Yes, flagship smartphones, but also server, auto, industrial IoT, networking, its latest and greatest chip technology, what kind of traction they're getting there, what kind of royalty rates are they commanding, and their role will be interesting to just hear more about in Stargate, that very high profile AI project. Their role in that as well, Julie, should come up.
Yeah, and will they be asked about DeepSeek and the effect of that on their business? That seems to be something that broadly across the chip industry is seen as a potential risk. So we'll see.
You got a very smart tech analyst who's going to help us walk through all of it. We sure do. Coming up, we're going to get you the latest earnings results from Ford as those shares are falling. Stick around. Much more market domination over time still to come.
Shares of Ford are down following its latest earnings results. Joining us now to drive us through the numbers, Yahoo Finance's Pras Subramanian. Pras, what do we hear from Ford?
The big news here is guidance, Julie. So Ford said its full year 2025 adjusted EBIT was going to come in at 7 to 8.5 billion and 3.5 to 4.5 billion in adjusted free cash flow. In comparison, 2024's full year adjusted EBIT came in at 10.2 billion. So a big kind of drop there. Ford said the guidance presumes headwinds related to market factors such as pricing, but that does not include things like policy changes like tariffs or EV tax credit losses. CFO Sherry House, the new CFO, said tariffs would have a major impact on the industry, but they did not include that in their guidance. Also, Ford's Q1 adjusted EBIT guidance would be break even for Q1 due to lower wholesales and product mix there. They're phasing out some products and bringing in some new vehicles. That's going to affect their sort of sales there. Finally, those Q4 numbers, revenue of 48.2 billion, easily topped estimates, as well as adjusted EPS of 39 cents a share and adjusted EBIT of 2.1 billion, all quite well there for the Q4, ending the year on a high note, but it's that guidance for 2025 that's weighing on shares here.
Thank you, Praz. Appreciate it.
Thank you.
Qualcomm and ARM both reporting quarterly earnings just moments ago and helping us break it all down. Patrick Moorhead, founder, CEO, and chief analyst at More Insights and Strategy. Patrick, it is great to see you. Maybe we'll start here, Patrick, with ARM. At least initially, investors don't seem too excited. We're down about 5% here in the after hours, Patrick, but give me your take on that report.
So if we look historically at ARM, I mean, it's been very consistent on the double beat and then raised guidance. I think this one's kind of a somewhat of a repeat of that. And I think the only thing, if people are being critical, you could look at is EPS guidance. But, ARM is a company that's investing ahead. It's likely more R&D, more engineers, but it's a very expensive stock. If you look at how it's trading, even on the forward PE, it's crushing it on growth. I mean, if you look at what it pulled in the quarter, it wasn't a few years ago. Their entire quarterly revenue and profit is what the company would crank out in an entire year. But again, it's all about valuation. I'm very interested to hear any talk about what Stargate may or may not mean.
And do you think that if we get a little more color and details around that could potentially help the stock recover? I mean, what do you want? What would be your question specifically around Stargate that the company even is in a position to answer at this early stage?
Well, it should be. It was part of the press release, and ARM CEO Rene Haas was recently on stage with OpenAI's Sam Altman in Japan. So there's definitely an affiliation. It looks as if ARM is the CPU of choice. Now, in all of the integrated NVIDIA solutions, ARM is already the CPU of choice in what's called Grace Blackwell and a prior generation. But I think if you can definitively say black and white that they are going to get a very high degree, I wouldn't expect him to say it's a winner take all, but to get most of the CPU business there, then the stock would absolutely skyrocket on that news. It should.
What, Patrick, does losing the Qualcomm suit mean, if anything?
So it's a little early to tell exactly what it means. I have talked to a few licensees, and they are asking a lot of questions about ownership of intellectual property. ARM is going back into the court system. They're not giving up at this point, but if what was decided stands, it would be a loss of revenue and profit from Qualcomm, not from the entire market per se, because not everybody can crank out a CPU that's as competitive as Qualcomm did with Orion, but it is right now it does appear as a loss until they can get the courts to reverse course.
Patrick, I want to ask about DeepSeek also, because pretty much everybody who's come on and who watches the industry closely has said it's not a big deal, or it's not the big deal that the market made it out to be. But it's not nothing. So I'm just curious how you're thinking through it, specifically for ARM, in terms of potential exposure, even if it's not DeepSeek, to some kind of model that really is going to be more efficient.
Yes, so there's a lot of talk about ARM in the data center. Their current bread and butter is in the smartphone business. I mean, they have a monopoly. I don't know if it's 95 or 99% market share in the smartphone space. And what DeepSeek showed us is that you could run very useful models on the smartphone without even connecting to the cloud. And I think, I know we keep talking about, and I have talked about this potential super cycle in smartphones. The challenge right now is the features haven't shown up, but DeepSeek could be one of those capabilities that shows us why everybody's going to need a new smartphone and a new PC that ARM is very competitive in. And whether that's via Apple or via Qualcomm today with the Windows Copilot Plus PCs.
Patrick, let's switch gears, talk about Qualcomm. Also just reported up about 0.7% now in the after hours. One question I had there, Patrick, Apple and these reports that its in-house modem system debuting this spring, what does that mean for Qualcomm?
So Qualcomm has been very prepared for this on two fronts. First of all, they've zeroed out any Apple revenue in the next few years when Apple is supposedly going to bring in this modem. And, I might add, it's been, 7 to 9 years since we've been talking about Apple, who acquired the Intel modem assets. We're still waiting for that modem. I do believe that they will. I think they'll be very conservative first. Maybe it will come out on an SE or maybe even a low-end tablet. But Qualcomm has been prepared for a scenario where there is no more Apple business. The other side is the diversification, right? If you look back 5 or 6 years ago, Qualcomm was pretty much 100% a smartphone play. They've diversified that with a very sizable automotive showing up in that. They have an IoT business, which is a function of pretty much everything that's not automotive and smartphone, including PC. And the numbers do speak for themselves. And they have a forward forecast where 60 to 70% of their revenue is non-smartphone related. Let's not forget that Qualcomm is the market share leader in all of premium Android, which is the market share leader globally. So a lot of puts and takes here.
A lot of puts and takes, but not a lot of AI and what I heard you talking about there. And I know it's part of it, right? They're big in what they call edge AI, AI on device, right? So I guess what I'm asking is all of what you're talking about enough to enthuse investors and bring them back to Qualcomm?
So Qualcomm has AI in smartphones, in PCs, in automotive, industrial IoT, and a couple other areas. Right now, where the action is in AI is all about the data center. And while they do have installations at the data center edge and in a few they're actually installed inside of AWS, they're not generating meaningful revenue or profits at this point. So I think it's going to take a culmination of two things. First of all, they're going to have to see some evidence from the ecosystem, and that includes Microsoft, all the PC makers, all the smartphone makers, that AI is accelerating their business. I think we have seen an acceleration of profits on the smartphone side that are related to AI with brands that are actually doing something with it finally, primarily out of China and including Samsung. But I think investors are saying, where's the beef, right? Show me proof of life. Show me proof that this is going to generate something meaningful, and then it's all going to fall in place there. I do believe it ultimately will, but investors are in a show me state.
Patrick, always appreciate that instant analysis and insight. Thanks for joining us, sir.
Thank you.
All right, shares of UnitedHealth closed lower today after a now deleted post on X from investor Bill Ackman suggesting the company was overstating profits. Ackman writing, "I would not be surprised to find the company's profitability is massively overstated due to its denial of medically necessary procedures and patient care." Company says it has contacted the SEC with concerns about the post. So Ackman goes on X, made this statement, fighting words. The company telling Bloomberg, health insurance has long been subject to significant regulatory oversight and earnings caps, says the claims that insurers can somehow over-earn are grossly uninformed.
Yeah, and so the company went to the SEC, and whether before or after that complaint, Ackman did delete the post. Now, Ackman, this is not to say that he is shorting the shares, right? He did not say that, but his most famous shorting of shares
Herbalife
didn't turn out well for him.
No, it didn't. I believe the shares more than doubled.
Unclear if he's got some sort of a position in the stock or what this was motivated by, but we'll see if the SEC does end up following up on that. But the shares, as you said, moved lower, closed up off the lows of the session.
Remember who was on the other side of that trade? Mr. Icon.
Oh, how could I forget?
What a fight. Time now for What to Watch Thursday, February 6th, sponsored by Tasty Trade. We're going to start off on the earnings front. Another big earnings day tomorrow, including a member of the Magnificent Seven. That would be Amazon, announcing results for the fourth quarter after close. Key focus for Wall Street will be how its cloud business, Amazon Web Services, is performing. Investors will also be watching to see if the company will follow suit with other big tech names and forecast big spending in 2025.
Taking a look at the Fed, we'll be getting a new round of commentary from the central bank. Fed Governor Christopher Waller, Dallas Fed President Lori Logan. This coming after comments today from Chicago Fed President Austin Goolsbee. He said the Fed could be, quote, in a difficult position when it comes to inflation as officials continue navigating the impact of President Donald Trump's recent tariffs. Jefferson joining a growing list of Fed officials who feel that the central bank should move cautiously with interest rates.
And moving over to housing, weekly mortgage rate data from Freddie Mac will be coming out in the afternoon. After eclipsing 7% a few weeks ago, the 30-year fix fell for the second straight time last week to 6.95%.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Markets ending the day higher, with the Dow leading gains. The Nasdaq managed to close in positive territory after being dragged down by less than stellar earnings from Alphabet. We're going to dive into the rest of today's market trends. Then we've heard plenty about what President Trump's newest trade war means for consumers and companies here in the United States, but what sort of impact will tariffs have in China? We're going to explore that. Plus, Elon Musk and his Department of Government Efficiency have made plenty of headlines recently. So how much of a difference will he ultimately make, though, when it comes to federal spending? We're going to try to figure that out as well. Well, a tariff battle between the U.S. and China is stirring up fears of a trade war escalation, but our next guest saying China would be better prepared this time around than in the last trade war. Zoe Liu, Counsel of Foreign Relations, Senior Fellow for China Studies, joining us now to discuss. Zoe, it is good to see you. So, listen, the U.S.-China trade war, Zoe, does appear to be intensifying. China is hitting back, retaliating. I'm curious, Zoe, what do you make of how China is retaliating? What is the message you think Beijing is sending?
Josh, it's good to see you again. I do think China is better prepared this time than the last round of a trade war. Part of the reason is because China has accumulated experience in the past few years, but more importantly, over the past few years, China has also been augmenting and refining its tools, as well as domestic legislative and administrative measures to hit back. So far, at least reading from the Chinese sources, China really has not been in a full mode of pouring oil to the trade war, but instead China has been very much cautious and in a mood of wait and see, and very much paying the way for additional negotiations. For example, China's 10% to 15% tariffs on U.S. LNG, coal, and oil. These are nothing to the same extent compared with last time. And China has also been has also expanded its export control measures in critical minerals. But this is nothing surprising at all, because for example, to be honest, perhaps the Chinese officials realized that their comparative advantage in critical minerals is diminishing in the long run, because US, Japan, the European Union have also been building their alternative supply chains. So in short, China is not necessarily in a full fire position or mode to expand the tariff, the trade war.
Part of what clearly upsets, Zoe, President Trump, is he thinks China is failing to prevent illegal fentanyl from entering this country. What kind of concessions do you believe the Chinese are going to be willing to make to appease Trump on that front?
Josh, that's a good point. And honestly, I am not exactly sure why and how effective that the president linked fentanyl and a tariff. And because, U.S. government official sources, including the DEA's annual drug assessment and the Department of State's assessment, they all pointed out that China is no longer the source of fentanyl, the finished product sold on U.S. street. Instead, is Mexico, right? But China's role here is that the small chemical manufacturers or producers, they became source of underground clandestine labs that produce fentanyl, say in Latin American countries like Mexico. So here, in order for if the goal is to curb U.S. fentanyl crisis, then obviously we have to do more on the demand side at home. And then on the other hand, we really need Chinese law enforcement agencies cooperation, not just at the central government level, but also at the local government level, at the distribution level, the postal services, for them to stop the flow of the chemicals that have legitimate use, but can also be used for the production of fentanyl.
I guess bottom line, though, I'm interested, given your sources, Do you think ultimately you're going to get a deal here between Trump and Xi Jinping, some type of deal that everybody can go home happy with, or no, do you expect this is going to be a bigger, broader, intensifying trade war?
I do think this time President Trump and President Xi Jinping, they are uniquely positioned to make a deal. Some people may say it's a grand bargain, but regardless how you frame it, I do think both leaders have a unique position. Part of the reason is because on President Trump's side, he has a firm grip on the not have
might have
any
lost over there.
trouble.
I'm sorry. Go ahead, Zoe.
Am I back?
You are back.
Okay, great. So on President Trump's side, he has no problem or very flexible in terms of his position. He has no problem walking back of the decisions that he made yesterday. And on the other hand, President Xi Jinping, he need the U.S. perhaps more than before in the sense that he need better relationship so that it can inject confidence in the Chinese economy. So from that perspective, these two leaders are uniquely positioned at this moment to strike a deal.
Zoe, always great to see you and have you on the show. Appreciate your time and insight.
Thank you for having me, Josh.
U.S. stocks recover from losses, closing higher as Nvidia shares pop and investors digest earnings. Yahoo Finance's Josh Shaver joins us now with the trading day takeaways. Josh.
Hey, Josh, yeah, so the day started with futures lower after disappointing results from Alphabet were dragging down the Nasdaq and stocks from a broader sense, but we did close higher, and I want to sort of break down two of those reasons. One of those is what you just mentioned off the top there, Nvidia closing up over 5%, and what I think is interesting here, Josh, is when we zoom out, we'll go 10 days so we can see our big drop from DeepSeek, right? So this is the DeepSeek new China AI model. Oh no, cheap AI is coming. These hyperscalers might spend less. That's going to hurt a company like Nvidia. Well, what have we learned over the last week? These companies are still going to keep spending, right? So we haven't heard from Amazon yet, but Alphabet saying they'll be up in CapEx more than the street expected. Meta up in CapEx, Microsoft up in CapEx, and something we heard from analysts throughout the day today, Nvidia had several pieces of news that were moving that stock, but one of them being these companies are still going to keep spending, and Nvidia is a clear beneficiary of them, as most of them are customers of Nvidia.
Yeah, for sure. And you mentioned that other news, which was the partner Supermicro saying, hey, those fancy new AI data center systems with Nvidia's Blackwell chips, they're ready. They're ready to ship. That helping too.
Yes, absolutely. Yeah. And on a day with Nvidia up over 5%, we know over the past 2 years, usually helps out for the market, right? But one other tailwind that we were watching today for the market, remember we were talking about the 10-year moving higher, right? We were talking about the 10-year near 4.8. When are we getting to 5? What are the levels to watch? Well, let's look at the 10-year now, Josh. The 10-year's at its lowest level since mid-December. It was down about 9 basis points today. There was a little bit of soft economic data in the services sector. Services starting to slow down a little bit more than they had been. But I want to get to that chart itself so we can just look sort of at the levels. We've really come a long way down since the beginning of January when we were sort of talking about the rise in the 10-year as a headwind. So here's your 1 month look of that. You can see coming pretty significantly down from when we were approaching toward 5. Now we're below this key 4.5 level. Right, and remember we had talked about above 4.5, above this dotted line, or sorry, this line here is when strategists start to say, all right, you're going to see not a lot of stocks outperform the market. People are going to get more selective. It's going to be harder. Well, as we got below 4.5, look at what we had today. How about the Russell 2000 up over 1%? You haven't seen that too much recently, right? And then you take a look at the sector action, Josh. Real estate, oops, I went the wrong way. Let's get to the sector action. Real estate was leading the sectors today, interest rate sensitive sector. So to me, just sort of this move lower that we've seen in yields, perhaps opening up opportunity for some more stocks to participate in this rally.
You mentioned quickly the economic data we got today. Big data point on Friday, jobs report. What are we looking for there?
Yeah, so jobs report right now, consensus looking for about 180,000 job ads, unemployment to stay flat at 4.1. That seems like a read that would probably, we were just talking about the 10-year headwind, probably kind of keep it in line, right, and be able to keep things moving. What I think would be interesting would be if you get a really soft report, if unemployment starts moving back up, does that concern come back into the market, and how does that sort of play through? Will be something we're watching on.
We will watch. Joshua, thank you. Stick around, much more asking for a trend still to come. We're taking a closer look at Doge's impact on the defense industry. And joining me now is Patrick Murphy, host of Yahoo Finance's Warrior Money. Patrick, always great to see you and have you on the show. I am curious, Patrick, as a former congressman, to get your take on Doge, our new Department of Government Efficiency run by Elon Musk, because as a former lawmaker, Patrick, you have unique perspective and insight there. So when you look at Doge, you think about Doge, its purpose, its mission. Is it a worthwhile effort, in your opinion, Patrick?
Absolutely, I think it is. And listen, cutting fraud, waste, and abuse is incredibly important. It's important for our American taxpayers. It's important for our national security. Josh, you know as well as I do, we pay in the United States $900 billion a year just to pay the interest off our national debt. So we got to cut some of the wasteful spending that we have going on out there. And as you said, I saw this as a member of Congress. I saw this as someone who ran the Army. We have to get after it. And I applaud the efforts. It has to be bipartisan. You can't ignore Congress. There's a Doge caucus in the Congress. They're trying to work with Elon Musk and his team, and we got to get after it as a country, as patriots.
Patrick, let me ask you about the pushback you sometimes hear. And the pushback goes something like this, that we really know where the big spending is. It's on our big entitlement programs. And if you really want to tackle it, you have to start thinking critically about the future of Medicare, the future of Social Security. But nobody right now on either side of the aisle seems to actually want to do that, Patrick.
Right. It's like getting to a rowboat, right? Both sides have to get in one at a time, and you have to be, partners in this. Because it is about our future. It's about our kids. Josh, I have two kids that they're both in high school, right? And, I don't want them to pay our debt that we're racking up as a country. We got to do a better job. So there are folks, though, I would say, that are really thoughtful on this. People like Mark Rowan, co-founder of Apollo, created the Wharton, basically the budget index. I teach at Wharton Business School. Like, to me, those type of solutions that would be bipartisan, get rid of some of the tax breaks that we don't need. I think we need to get after it as a country.
Patrick, you're a former congressman. You're also a veteran. I am curious whether you think Doge could ultimately result in cuts in U.S. military spending down the line, or do you think, Patrick, little chance of that, just given the geopolitical environment and backdrop we find ourselves in right now?
Yeah, I'm actually hopeful, Josh. I just heard the testimony of the person who was nominated to be the next Secretary of the Army, right? And I was the acting role at that time under the President Obama administration. And excuse me. And he said, listen, we don't need to reinvent the wheel here. There are some COTS, some commercial off-the-shelf technologies that we could use for our warfighters. We can't necessarily have these cycles of 2, 6, 10 years to have an idea, to get it, to put it in the field, especially when you look at war fighting right now, what we see Russia, Ukraine with the drone use, et cetera. So there's a lot more we can do, but it goes back, Josh, also to our defense industrial base. I'm hoping there's a fresh set of eyes in Washington, D.C. now that will really look at this. Why is that important? We just had a deal. It was Nippon's deal was trying to buy a U.S. deal, about $16 billion, $15 billion deal. They're going to invest another $2 billion. There was a review on it called a CFIUS review. It basically said this is the national security interest of America. And why is that? Steel is important. Our manufacturing and modernizing that is critically important. And it was nixed. We got to get after solutions like that. That was, a private sector investment of the U.S. Steel company, $15 billion worth. And every steelworker was going to basically a $5,000 basically bonus. Why is that important? We have other foreign companies like BMW, Toyota, that are doubling down on American manufacturing. That's the type of modernization that we need today that is tied to our national security and our economy.
Patrick, always great to have you on the show, sir. Thanks for joining us.
Thank you, Josh. Appreciate you, brother.
And be sure to scan the QR code below to check out Patrick every Friday at 12:30 p.m. Eastern on the Yahoo Finance podcast, Warrior Money. In this past episode, Patrick and his co-host, Dan Cunez, were joined by Life Skills for Soldiers founder Brendan Dubner to discuss why he started his nonprofit for soldiers. Take a listen.
defense tech companies Palantir and Booz Allen recently announced a partnership. Dan, let's get into it. What you think?
Yeah, so the announcement came in the early part of December, and this is slated into the next earnings season. I think one of the really interesting parts of the press release was the two CEOs of the organizations talking about how they're going to deliver quickly and at scale. And you know as well as I know that the Department of Defense is interested in the challenge set, not only because of how fast they need things, but at what size and complexity they need to. So like interoperability, artificial intelligence, cyber, all the things that we really care about. Like you need a services partner, a strategic partner to be able to deliver that at scale and execute against the mission. So it's a smart play.
And especially when you look at Booz Allen, about $10 billion a year in revenues, Palantir, world-class in AI, machine learning. So to see that public-private partnership, these two private companies partnering with the government, definitely giving our warfighters a tactical advantage over our enemies.
Yeah, it's also kind of funny because you see like all these, we talk about this alternative versus traditional defense contracting. And it's like at some point in time, even the most alternative organizations have to start to deliver at scale. So like when I see Palantir partner with Booz Allen, you're starting to see an alternative defense tech company starting to partner with a more traditional defense integrator to be able to deliver this sort of stuff at complexity and scale. So it's like, as we talked about before, it's like the next 4 years, next 8 years, people really got to start to like, once the rubber hits the road between like great ideas, all right, now let's do this at a really big scale. So it becomes really hard that way.
Yeah. I always talk about, having the vision and how can you anticipate what's coming around the corner.
Yeah, like we actually have to deliver this now. So that makes it a little bit harder. So there you go.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
For our chart of the day, we're taking a deeper dive into all the big tech spending forecasts this year. And Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, we've been talking a lot about this all day. We're going to be talking about it again after we hear from Amazon as well, and maybe get some color around its CapEx forecast when it reports tomorrow. So spending for future growth, that's the idea anyway, that these companies are spending billions and billions of dollars to build out AI data centers, and then eventually they'll get a decent amount of money back in the form of growth. So breaking it down here, let's start with Alphabet, right? Alphabet has said it is going to be spending $75 billion this year on its CapEx. That is an increase of more than 40% that we're seeing here. And yet the revenue growth this year is expected to be in the teens at around 17%. Amazon of these is probably the closest, at least if you look at the estimates for its CapEx this year and next. It is looking for about a 14% increase in CapEx and an 11% increase in revenue. But we'll get confirmation of that, hopefully, when the company reports. The biggest sort of dispersion, if you will, between the two is Meta, which is increasing its CapEx by about 66% if it hits that high end of its target for $65 billion in capital expenditures this year, whereas its revenue is only expected by analysts to grow about 15%. And then finally, we have Microsoft, which just came out with its capital expenditure plan of $80 billion. That would be an increase of more than 40%. At the same time, again, that its revenue is expected to grow 13%. Now, you might say, well, they're spending all this money now to build these data centers to power growth for the future. But analysts aren't yet factoring in that growth. If you look beyond 2025 to estimates for 2026 and beyond, they are still not looking for much more than teens percentage growth. We talked to Daniel Newman of Futurum earlier, and he sort of laid out his scenario for where he thinks this growth is going to come from.
Right now, it's very little. We're hearing very little. Microsoft spending $80 billion to make 13. But companies are doing this, hundreds of times, thousands of times. They've deployed it to 1%, 5% of their workforce. If they can get this deployed to 50% of their workforce and then get those pennies per action at scale, that's where I see it happening.
So the most important word, and what Daniel was just saying, is scale. If at some point you can get high enough adoption of these AI-powered services that these various companies are selling, then that's how it's going to translate into that growth.
All right. Thank you, Julie. Appreciate it. Now let's take a look at what's trending here after hours. First up, Symbiotic. That stock is slumping following Q1 earnings, with the warehouse automation company missing on revenue and offering second quarter revenue guidance below the street's estimates. Meanwhile, Coherent surpassing Wall Street's expectations on second quarter earnings and revenue. CEO Jim Anderson citing strong AI-related data center demand and growth in its telecom business as key drivers in the quarter. Coherent also highlighting debt reduction, paying down $132 million of its outstanding debt. And next up is Sonos. Shares of the audio equipment manufacturer moving lower after it announced a reorganization and reduction in its workforce. The move is expected to impact about 12% of employees. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.